So hello, dear students, how you can hear me? So trying to manage my microphone. Can you hear me? Please let me know. We are going to start the class already. So should I adjust any volume? That's fine, right? So, okay, so let's see. I have given you homework assignment based on the ratio analysis, right? To calculate the accounting ratios. So, as I chat for you that I received only the homework assigned from 2 students only, and yeah, that is that picture. I mean, if you have any question, you should ask me or email to me. If you have some questions related to homework assignments, don't be fair, don't be ashamed. It's normal that you have questions. And as I know you have a Ramadan time, but you must be responsible for your study because you pay for this MBA study, right? You do some efforts, right? And actually, for me, I try to do my best in your classes. I know that we need some practical exercise. We have a class for practical exercises only. We do some calculation for ratios. And I know that some of you say that you didn't find some formulas for some ratios, right? But you remember that in the last presentation, there is given the presentation with the formulas, and you also at the end of the presentation you have the list of the formulas. But if you didn't find any formula, that is a simple solution for that. You just can open the books that I send you, and you can find the formulas inside of those books. For example, just a moment. The second ebook that I given you, the finance, just a moment, the finance and accounting for non-financial managers, right? The author is Samuel Weaver and the Fred Weston. So this is very good ebook because there is all the formulas for the ratios, for the metrics you can find, an explanation with those and examples. And also, if you you haven't read the ebooks, you also can use your internet search and find the formulas from other resources. That is simple. I mean, you are already master students. You must be able to have some solution to make your homework assignments, right? So I just want to give you the name of the books that I sent you. Just a moment. It's the authors for those books. Just a moment. So here is the author is the Samuel Weaver. Just can open your ebook and we can see what we have. And just a second. And that the 2 students that sent me the homework, they do right. I mean the answer was correct, and I am very satisfied for that. This is I want to say that this is the result that those students do understand the homework assignment, and they define the formulas for some ratios. So here is, look at here, the Finance for Non-Financial Users ebook, the authors Weaver and Weston. Try to open this ebook if you have in your desktop, in your notebook right now, and I can give you the page number for the metrics is, just a moment. So here the financial performance metrics, it's called, the page is 139. So the page 139, please, if you have this ebook right now, you should have in your emails also. Try to open, we can open together and see and see that the chapter which called the financial performance metrics, and page is 139. So you, in this page, in this chapter, you can find all the formulas related to ratio analysis with the examples, with the right answers, and with the explanation. Okay? So, and let's back to our exercises just a moment. So, here is, just a moment. So, I have given you the homework assignment based on the practical exercise, based on the ratio analysis, right? Can you see the presentation? So here is, we have, the question is, the harvester, this is company's name, the harvester, sells spare parts for agriculture machinery. And his financial statement for the years have been summarized below. So we can see the income statement for 3 years, for year 6, for year 7, and for year 8, right? So we have a sales on credit. We have a less cost of goods sold, which is the opening stock. We have purchases, and we have some closing stock, right? Okay, we have a gross profit. It's already being calculated. We have a less expenses, some other administrative expenses. We have a loan interest, and so the loan interest, I think this is okay, the loan interest one and loan interest second one, we have one, and we have a net profit, right? You can see. So let's see the next page. So on the next page we have a balance sheet, right? Balance sheet same for 3 years. And the assignment here is, we have a required to calculate the following ratio in respect for each year. So A, we have to calculate the gross profit percentage on sales. B, net profit percentage on sales. The C, rate of stock turnover. The stock, it's the same as inventory turnover. D is the return on capital employed. The E is the current ratio. The F is the quick or acid ratio, we call it. And G, we have a debt collection period in days. And this is here is given note that the based on closing debtors. That is very important. So I have to say here is, I have some mistake on this balance sheet. Here is, if you can see the year 8, at the year 8, total assets given to you 680, but it's wrong because it's been left the fixed asset plus 202, and total will be 882, same as the total liabilities in equity, 882, right? Okay. This is how. Just a moment. some, I think this is like some misprint, like from the books. That's fine, because if you know how much is the total, if you can see, if you know the fixed assets equal to 202 and plus current assets which is equal 680, you can just adjust. The fixed assets to current assets, and you will get the total assets for this balance sheet, right? So let's see the solution for this exercise. So first, we do calculation for gross profit percentage on sales. So what is the gross profit percentage on sales? This is calls gross margin. It develops a profitability relationship between the gross income and sales, where the gross income or profit, we call it, equal to sales minus cost of goods sold. So here is gross income represents the inherent profitability for making a product, right? And cost of goods sold encompasses the total cost of production, which includes the raw material, direct labor, plant overhead, and so on. So after it's observed the cost of making the product, how profitable is the company? We calculate the calculation. We can see the result from the calculation. We can see how profitable is the harvester company, right? So if you can see here is the assignment they given you that the gross profit percentage on sales. So here is, sorry, you can see that this sentence is already given to you a formula, gross profit on sales, right? Let's see the next slide. Here is, we divide the gross profit on sales and multiple 100 to see in the percentage, right? So here is the calculation we have for year 6. Look at here is. So we have a gross profit, which is for year 6 equal 160. You can go back on your balance sheet and see, or sorry, on your income statement and see the gross profit. So here is given to you 160, multiply 400 to see in the percentage, and divide for 800, which is equal to sales on credit. So, and given to you, the answer is 20%, right? So that means in harvester case for year 6, it made more than 20 cents for every dollar of sales for each product. Okay? Do you understand this sentence? What that means? That the harvester made 20 cents for every dollar of sales for his product. Made a profit. 20 cents for every $1. Let's see the next one, year 7. Here we have a calculation, and the result is given to you 16.66, around 17%. Let's say that means for year 7, harvester made more than 16 cents for every dollar of sales of its product, right? And let's see the years 8. We have it's around 15%, right? That means for year 8, the harvester made 15 cents for every dollar of sales for its product. Okay? So any questions to gross profit presentation sales? Any questions for first calculation? I think that should be clear, right? So let's move to the next one. So some of you can't hear me. Please adjust microphone or manage your microphone, because that is very important. Today class is important because it's based on the practical exercise. So far, what's about the rest of C? Can you hear me? Just let me know, please, and we continue. Anybody here? Hello? Hello, anybody here? Can you hear me? Because some of you says you can't hear me. I must to try to solve this problem. If it's my problem with the microphone. So you can hear me, right? Okay, don't sleep, please. Listen here. So the next question. So next is then we should calculate the net profit or income percentage on sales. So given formula to you, this is net profit we divide on sales and multiply 100 to see in percentage. This called a net margin. Okay. Some of you say I'm too loud. Sorry. So year 6, let's see. Okay, year 6, we have a net profit which is equal to 80, right? We divide on sales which is equal to 800 and multiply on 100. We get 10%. What that means? That means for every $1 of sales, harvester generated 10 cents of net profit or income. Net profit, which means after paying all these operating expenses, interest and taxes in year 6. Okay? So let's see the next one. Year 7, after calculation, we have a net margin 8.7%. That means for every $1 of sales, harvester generated around 0.087, around 1 cent of net profit in year 7. Let's see the next one. The year 8. For a year 8, we have a net margin which is equal to 6.9, around 7%. That means for every $1 of sales, harvesters generated here is given to $0.069 of net profit. It's less than 1 cent of the net profit in year 8, right? So, if you can see, based on this calculation, we can see that downturn of the net margin. Yes, because we have in the year 6 is 10%, then it decreased in the year 7 to 8.7. After it also decreases to 6.9 in the year 8. So if you have a downturn of the net margin, actually this shows a bad picture of the company. That the net profit from the sales decreases year by year. And we have here is, if you can see, there are 2 ways to improve the net margin of the company. So first way is to reduce your expenses, all expenses, which is we have cost of goods sold expenses and administrative expenses too. And another way is to increase your prices on your product or your services. So here is given to you just as example 2 kinds of method how you can improve your net margin, right? So that's clear, right? So let's see the next one. Okay. So C, here is the rate of stock or inventory turnover in days. So what is measures this inventory turnover? It measures how fast the stock or inventory is moving through the firm and generating sales. It helps to maintain a proper amount of stock to fulfill the requirements of the concern. A proper inventory turnover makes the business to earn a reasonable margin of profit. Okay, this is some definition to you to deeper understand what is inventory turnover, what it shows. So let's see the next one. Here is given to you the formulas. First, you must remember that stock is its inventory. It's the same as inventory, just two synonym words. Sometimes we use the stock turnover, the definition. Sometimes we use the inventory turnover. You won't be mistaken if you confuse with this and use one of them. So first formula. So first, to see the stock turnover in days, we have to check the 365 days, which is the days in 1 year, and divide on the inventory turnover. And we can see the inventory turnover in days, which means inventory days outstanding. It's called the inventory days outstanding. Outstanding. And to calculate the inventory turnover, the formula given to you: cost of goods sold divided on the average inventory, right? So to see the average inventory, do you remember on the last class I given to you the definition how to find the average inventory? Just take an opening stock and add the closing stock and divide on 2, and you will get the average inventory. Yes, this is the math calculation. So let's see the calculation itself. So here is the calculation based on formula 2, which means first we should calculate the stock turnover, and then we calculate the stock turnover in days, which is based on the formula 1. So here is based on the year 6. We have 640, which is the cost of goods sold. We divide on the average inventory given to you. 40 is the opening stock, and 50 is the closing stock. To get average, we divide on 2, and we've got the 21.33. Yes, right. And to get the stock turnover in days, we have to 365 days divide on 21.33, which is stock turnover, and we get the 17 days. The answer is that every 17 days, Harvester sells off its entire inventory in year 6. That means every 17 days, Harvester sells its inventory. It sold its inventory in the year 6. Every 17 days. Okay. Let's see the next one. Year 7. So we calculate first the stock turnover, which is equal to 14, right? And then we calculate the turnover in days, the inventory outstanding, and we have got the 26 days. That means every 26 days, Harvester sells off its entire inventory in year 6. Let's see the year 8. And we got inventory turnover 9.86, right? After that, in the days outstanding, we have inventory that every 37 days, you can see that Harvester sells off its entire inventory in the year 6. So here is given to you the stock turnover based on 3 years, right? As you can see, we have some, as we can see, the increases in the days that Harvester sells its products. It has been increased year by year. You can see. The rising the days of the inventory turnover. So, and you have to remember that the less the stock turnover, the days outstanding, is the better for the business. If you can see that your inventory days, the outstanding days of the inventory has been rising every year, that gives you a bad push for the company based from the profitability side. That means your inventory being outstanding in your stock, and you have to sell it faster. The faster is inventory turnover is better for businesses. And if you have some of this kind of situation, you must think about how to solve your problem with the inventory. Should you find some additional suppliers or customers? Should you manage the chain about the inventory? So think about this. Think about this situation. How to improve your inventory turnover? Any idea for this exercise? Any idea for these harvest situations? How you can improve your inventory turnover? That means increase the fastest we can say the turnover of the inventory. Maybe you should find you should I think you have to find some new customers. To attract the new customers, you should have some the market idea, some market investigation, right? So this question is directly related to the marketing. What do you think, right? Some of you say, Mr. Aman Nawadi says yes, it's about the marketing of the products. Maybe you should widen the market to go on international markets or to find another niche of markets. So here is think about this. So let's see the next one, okay? So DU, return on capital employed, or sometimes we call it ROCE. So to find this rate, to find this metric, we have given to you calculation. We should take the net operating profit after tax divide on the capital employed and multiple on the 100 to see in the percentage, right? The net operating profit after tax is clear, right? You should look at your income statement, and at the end of the income statement you can see the net profit, which is we have got from after all expenses made, interests, taxes, and so on. And you'll get the net operating profit after taxes, right? That's clear. What is the capital employed? The capital employed is equal to total assets minus current liabilities. So here is current liabilities. We know in the balance sheet what that means. What is the total assets? You know, it's a fixed assets plus current assets, right? So this return on capital employed, the rate is established the relationship between the profit and capital employed. That capital employed, the working capital means. The working capital, the capital we employed, it could be the investments from shareholders, it could be some profit from the last year, plus it could be some long-term liabilities like loans or credits from the banks, some debts also. And this rate indicates the percentage of return on capital employed in the business. It can be used to show the overall profitability and efficiency of the business. So this formula is very important, the return on capital employed, because it shows the overall profitability and efficiency of the business, okay? Let's see the calculation. So here is, okay, year 6. We have a net profit which is equal to 80, And we have here is the fixed, which is fixed assets, which is equal to 178 plus current assets 170 minus current liabilities. This is capital employed formulas. Multiple on 100, and we have got around 34%, right? That means for every $1 of capital, harvester generated 34 cents in year 6. Okay. Here, look, see the year 7. Year 7, after calculation, you have got 39%. For every $1 of capital, harvester generated 39 cents in year 7. Okay. And for the year 8, we have a return on capital employed 22.64%, around 22. So that means for every $1 of capital, harvester generate 22 cents in year 8. Okay. If you can see, here is we have a sum of, okay, based on the year 7, we have an increase compared to year 6, right? Increases the rising of our return on capital around for 5%, right? But after that, in the year 6, we have some decrease. The downturn for the year 8 is around 22% only. So to understand this kind of situation, you must find the problem. What caused this problem? What caused the decrease in the year 8 based compared to year 7? Any suggestion for this? You can find maybe your expense has been increased. Maybe your inventory been outstanding, right? You remember our inventory in the year 8, it was around 37 days. Maybe our inventory is like long been outstanding in the stock. So you to get the answer for this kind of situation, you must investigate all your expenses and your sales, which is caused like the decreases, which is caused the fault in the return on capital employed. Okay. Okay, and you should remember that all these kind of calculations, the numbers given to you, if you can see, can see the math calculation already, right? We can see the we can see the numbers and figures only, the changes, increase or decreases. But as your masters, as your the future finance mentors, maybe you must image the picture like from this kind of numbers and figures, the picture, what is caused, why is like this, and to get the reasons for those situations. Okay. Just a second. So okay, let's see the next one. So we have a current ratio. So calculation for current ratio. Let's see. The current ratio shows the short-term financial position of the business, right? This ratio measures the ability of the business to pay its current liabilities. The ideal current ratio is supposed to be 2:1, which means the current assets must be twice the current liabilities. This is important. The current assets must be twice the current liabilities. In case this ratio is less than 2/1, the short-term financial position is not supposed to be very sound, and indicate it's more than 2/1. It indicates the idleness of the working capital. Let's see the calculation for the current ratio. You remember the formula: current assets divide on the current liabilities, right? And we can get the current ratio. So in the year 6, we've got the 1.5 current ratio. That means for every $1 that harvester owes over the year 6, it has $1.5 which to pay it off. So that means you see that the $1 that harvester owes from, for example, from the bank, it must pay more than it, $1.5. In the year 7, we can see the current ratio is equal to 1.4. Okay, that for every $1 that harvester owes over the year 7, it has $1.4 which to pay it off. And the year 8, we have the current ratio is equal to 1.9. For every $1 that harvester owes over the year 8, it has 1.9 which is to pay it off. It has around $2 to pay off. So if you can see, we have some improvements in the year 8, right? The improvements, because the current ratio is around equal to 2 based on the present, based on the previous, the ideal current ratio is supposed to be equal to 2. Must be twice the current. Here in the year 8, our current ratio, our current assets is around twice our liabilities, right? Our current liabilities. But you can see in the year 7, the situation is being changed and being decreased compared to year 6. The ratio is 1.4. Why is happen like this? That means in this year, in the year 7, that means our current liabilities being increased. That means our liabilities, our some debts, loans, is being increased, or our assets is being decreased. So you must investigate to see the full picture, to see the reason why in the year 7 we have decreases to 1.4 of the current ratio. Okay. So let's see the next one. We have okay, the calculation for quick acid test ratio. Quick ratio or acid test ratio. Sometimes we call it liquid ratio. Maybe you have heard about liquid ratio. So quick ratio is calculated to work out the liquidity of the business. This ratio measures the ability of the business to pay its current liabilities in a real way. The ideal quick ratio is supposed to be 1/1. That means liquid assets must be equal to current liabilities. In case this ratio is less than 1/1, it shows a very weak short-term financial positions, and in case it's more than 1/1, it shows a better short-term financial positions. Okay, let's see. Calculation. This is the calculation. Here is given to you formula. Current assets minus inventory. So to get the quick ratio, we must deduct the inventory from the current assets and divide on the current liabilities. Okay. So in the year 6, after calculation, we've got the 1.07 around 1 quick ratio. That means for every $1 that harvester owes over the year 6, it has $1 to pay it off in current assets, excluding the inventories. Okay. In the year 6, after calculation, we have a 0.98 quick ratio. That means for every $1 the harvester owes over the year 7, it has 98 cents to pay it off in the current assets, excluding the inventory, right? In the year 7, we have a 1.36. So you can see that for every $1 that Harris owes over the year 8, he has $1.36 to pay it off in the current assets, excluding the inventories. And this means we have some improvements, same as before the current ratio in the year 6, right? Because it's equal to 1.36. Compared to year 7 and year 6, it's been increased. Same situation with the year 7. Why the quick ratio has been decreased, it's fall to 0.98. This is the question for you to think about. Okay? So do you understand this quick ratio? Let's move to the next one. So here is the G is the debt collection period in days based on the closing debtors. So this debt collection period ratio we must calculate in days first. This node the first in days, the second node based on closing debtors. That is very important because first remember in the income statement you have opening stock and you have sorry for this one is closing debtors. You already have closing debtors in your balance sheet. Okay. Okay, let's see. The debt collection period is a period over which the debtors are collected on an average basis. It indicates the rapidity or slowness with which the money is collected from the debtors. The shorter the period, the better is, and longer the period, more the chance of the bad debts. You remember the bad debts, okay? Although no standard period is prescribed anywhere, it depends on the nature of the industry. So, as you know, debt collection period, I think you have this formula in the presentation, but you have this formula in the list of the metrics. Okay, let's see the calculation for debt collection period. So, to see in the days, we should take the average debtors, or based on our assignment, we should take the closing debtors, not the average. Sometimes in the balance sheet, we have, in the income statement, sometimes we have the debtors in the beginning of the balance sheet and debtors at the end of the balance sheet. So, and you should take the average one. But in this sense, you should take closing debtors, which is given to you in the balance sheet already, and divide on the credit sales. Credit sales we have already, yes, you remember, we have in the income statement the sales on credit, and multiply on the 365 days. So in the year 6, after calculation, we received 45.63 days, around 45 days. That means in year 6, harvester took 45 days to collect money from its debtors. Okay. In the year 7, after calculation, we have got the 60.83 days, around 61 days, right? That means in the year 7, harvester took 61 days to collect the money from its debtors. In the year 8, after calculation, we have got the 100.70 days, around 101 days, right? That means in the year 8, harvester took 101 days to collect money from its debtors. Now, let's see. In this kind of situation, we have increasing in the days by year. Okay. And you must remember in the previous statement that given to you, know that the shorter the period, it's better. Okay, that means if the days of the debt collection period would be decreased, downturn, it would be better for the harvester company. But in this situation, it's being increased. That means we have a slowness from the collection, money from the debtors. Why this situation being happen? You have to investigate also. Maybe you have given some credit on sales. You haven't increased the days on the credit on sales for your debtors. You must investigate why this situation been happen. This is the best situation for the company, because if you are slowly collecting your money from your debtors, that means it will be difficult to you to pay for your current liabilities. Okay, and maybe this is the part of the answer for your current and quick ratio. You remember it, so you must to link your debt collection period to another ratios, which is include your credit sales or the collection period debtors. So I have some questions asking me how calculate the average debtors. Average debtors. Okay, let's back on the balance sheet. You remember, in the balance sheet you have just a line which called debtors. That is already closing debtors. Sometimes it could be given to you that opening debtors now with some figures, and another line could be the closing debtors. And calculate the average one, you must opening debtors plus closing debtors and divide on 2. This is the math calculation how to get any average amounts. If you would like, just opening plus closing divide on 2. So here is okay. That's all for this kind of exercises. So any questions so far? If no question, we can move to another exercise. Yes, clearly, because today we do exercises based on ROCE analysis, and the next session we move for another calculation, for another ratios, for another analysis. And we won't be back for ratio analysis. And now, for today's session, you must be a very, how to say, you must do understand the ratio analysis and get all the formulas. Must be very, let's say, carefully for the exercises. Yes, clear, thanks. So let's see the exercise number 6. Here is, I have given to you exercise already with the answers, with the formulas, okay? Here is. Some of you asking me to send the presentations. After class, we'll send you all the presentation I have for today. Don't worry. So let's see another exercise based on the ratio analysis. So let's see, here is on the slide, you have a balance sheet in dollars, in millions, and you have some income statements in millions. Okay? This is given to your balance sheet to calculate the ratios. We can see the balance sheet given on the 1998 year. So we have assets. We have a cash. We have accounts receivable, the inventory, right? We have a fixed assets also, the property, plant, equipment, less accumulated depreciation. So total assets equal to 3,300. So we have current liabilities with accounts payable 600, notes payable 300. We have long-term debts 1,300. We have a total long-term debts. We have owner's equity, common stock for 1 par. We have capital surplus. Capital surplus means profit. We have some retained earnings, and the total liabilities and owner's equity equal to 3,300. Okay. And income statement, as you can see, we have sales, cost of goods sold, the administrative expenses, depreciation expenses, right? The interest expenses, some taxes, some dividends, and some additional the retained earnings. And also additional information for you that the numbers of shares outstanding and the price per share. Okay. Let's see the assignment itself. So calculate the following ratios. Here is given to you a number of ratios: the current ratio, quick ratio, time interest earned, return on equity, the debt ratio, payout and retention ratios, receivables turnover and days receivables, debt to equity ratio, the price unit ratio. Sum of ratio is in use for you. Maybe you don't have the formulas for this ratio, but based on this exercise, we can get all the formulas for those kinds of ratios and calculate itself. Okay, like equity multiplier, like a market to book ratio, you don't have it in your formulas. What else? The fixed asset turnover, post merger in EPS, and book value per share, you don't have the formulas. The total asset turnover. Okay, some of you, I think you have it. The times interest earning. You have in the presentation. Yes, I remember you have it in the presentation. Maybe you don't have the price earnings ratio also. So some of them are new for you, but don't worry about that. We can find in the here is so. First, let's see let's calculate the current ratio. After the calculation, we have got the current ratio, which is equal 1.56. The explanation, you remember the current ratio formula, the total current assets divide to total current liabilities, right? Where the total current assets equal to $1,400. Sorry. And total current liabilities, which is equal to $900, right? So you can go back on, let's see, go back on the, maybe I would like to open in parallel the same exercise, sorry, and we can see the balance sheet and income statement. So just a moment. I would like to share with you some files. Okay. Same file. This is the same presentation for the exercise is number 6. Just, okay. Just have open to you the balance sheet and the income statement. Okay, let's see. The current assets are, you can see 1,400, right? Okay, total, the total current assets are 1,400, and current liabilities, okay, it's 900, right? Okay, that's right. The calculation is right. Any question? No question so far for current ratio. That's a simple one. Yes, right? Next, see the next one, the quick ratio. You remember the quick ratio? We should deduct the inventory from the current assets. You remember inventory is we got the quick ratio, which is 0.33, right? And here is based on this formula, we have added the inventory $1,100. Let's back on the balance sheet. Let's see our inventory. Okay, right. You see, showing you the inventory 1,100. Yes, we have this line. Okay, right. So we got the quick ratio. You remember the quick ratio that should be 1 by 1? It should be equal to 1. That your total current assets should be equal to current liabilities. If it's less than it, it shows the bad short-term financial position of the company. So in this company, we should improve our quick ratio. Maybe our inventory is outstanding, is too big inventory. Yes, and we should work with our inventory. Work on the inventory, what we can do with inventory. Go back on the marketing, find a new customer and so on, right? To decrease our inventory. Quick ratio is same as the acid test ratio, given to you formula and calculation. It's total current assets, which is equal 1,400 minus inventory 1,100 divided on 900. We have got 0.33. Okay, this is understandable. Clear? Please clear. Let's move. I think this clear one, yeah? It's the same as the formula, same as in the previous one. Just different figures only, different numbers only. So let's see the next. Receivables turnover. Oh, sorry, receivables. So sorry, I have some questions. Some of you, Mr. Muhammad Aziz, he didn't understand the quick ratio. If you have your calculator, you can make a calculation yourself. The 1,400 minus 1,100, it will be 300 and divide on 900, and we have got 0.33. Okay? And please, when we have some practical exercises, prepare your calculator on the table, so you can do calculation yourself, and you can easily understand the assignment. So let's see, we have receivables turnover ratio. So it's after calculation already equal to 28.5 times, right? The explanation how to calculate the receivables turnover. Yes, I think I remember you have this formula in your presentation. It's called average receivables turnover. You have this formula. We have checked the sales divide on the accounts receivables, right? Where the sales is 5,700, we divide on the accounts receivable for 200, and we have got 28.5 times. That means the 28 times you receive your money from the customers in the year. Every 28 times you receive your money from the customers. Okay. How to calculate the in days receivable? So you just take 365 days and divide on the receivables turnover, which is equal to 28.5. And the answer we have got around 13 days. That means every 13 days you receive money from the customers. Okay? That means maybe you have some sales on credit and you haven't get the payment, the cash in your accounts, and your customers pay you the money every 13 days. Okay, that's understandable, right? Let's move. Any questions so far? Let's move. Inventory turnover. You remember inventory or stock turnover rate is equal to, after calculation, equal to 1.09 times. You remember the formula cost of goods sold, COGS. It means cost of goods sold divided divide on the inventory, which is cost of goods sold equal to 1,200. We divide on the inventory, which is equal 1,100. Let's back on our the balance sheet, and you remember inventory we have 1,100, and let's see on the income statement our cost of goods sold is line given to you 1,200, right? So the figures all right. So in calculating the days inventory, we should just take a 365 days divide on the inventory turnover, which we calculated before, and we have got the days inventory is 334.86 days, around 335 days. So what do you think about this? I think this is equal to 1 year, right? That means the company's inventories is being very long time been outstanding in the stocks stock. It's already is actually not moving. The inventory is not moving. That show you a very bad situation of the company. You shouldn't get this kind of inventory which is equal to 1 year. That your inventory are not being sold. Your inventory is still in your stocks. It still having savings in your stocks. You have a very less sales. Or you do a lot of, maybe your production been increased. Your production been increased, but your customer has been decreased. Maybe you have lost some customers, and your inventories is been outstanding in the stock. Okay, this is like a definition for the situation. So what do you think? Any suggestion? Why this inventory turnover is equal to 1 year? It's been outstanding. It's not selling. Any suggestions for this situation? You shouldn't have in your company this kind of inventory if you are a production company. So let's see the next calculation is the fixed assets turnover. How to calculate? So calculation given to you, after calculation given to you is 3 times. Explanation. How to calculate the fixed assets turnover? We should take our sales, divide on the next fixed assets, where sales is equal to 5,700, divide on the next fixed assets, the total fixed assets, 1,900. It's 3 times. And equal to 3 times. That means your fixed assets being used 3 times over the year to sell your products in your production. That means your fixed assets are being used three times every year. If the more these times, when your fixed asset turnover is decreasing, it's better for the company. The faster you're using your fixed assets to get the sales, it's better for the company. Okay? Let's see the next one. So total assets turnover. After calculation, we have the 1.73 times. Here is the explanation. We should take the sales, divide on the total assets, and we've got the 1.73 times. You know that the sales is 5,700, total assets is 3,300, right? Around 2 times. That means you use all your assets of which is in your company you use it 2 times in the year, 2 times better that you sell your products. compare your sales. Okay, let's see the next one. We have a times interest earned. I don't remember. Do you have this formula in your presentation? Must check. I think you have this formula in your presentation. Anyway, after calculation is 48.25 times. The formula is equal to EBIT, which means earnings before interest and taxes divided on the interest expenses, where earnings before interest and taxes equal to 3,860. We divide on interest expenses 80. Let's see the income statement. If you want to find these lines, these figures, okay, we have the interest expenses equal to 80, right? This one amount I'm showing to you in the presentation is and earnings before interest and taxes is 3,860. Yes, you've already got these amounts, and you can do a simple calculation. Oh, sorry. Okay, let's see the next one. We have a debt ratio. How to calculate the debt ratio? So it's equal to after calculation is equal to 66.67%. Debt ratio is calculated by the total assets divided on the total assets. Sorry. Total is actually total assets minus total owner's equity divided on the total assets. I think I've been mistaken a little bit maybe. Okay, the formula is this one: total assets minus total owner's equity, and you can get your debt ratio. Okay. Sorry, the total assets total assets equal to 3,300, right? And total owner's equity is equal to 1,100. So, and we've got the debt ratio, which is equal to around 67%. You must be know that the total debt is computed by subtracting the total owner's equity from the total assets. This is a formula for you. If you don't have this formula, you can copy it for your presentation and save it. Let's see the next one. Any questions so far for the debt ratio? No questions here, right? Okay. How to calculate the debt to equity ratio? Okay, after calculation is we have got the 200%, right? The formula given to you to calculate the debt to equity ratio, you should take the total debt divided on the total owner's equity. To get the total debt, you should take the total assets minus total owner's equity and divide on the total owner's equity, right? After calculation, okay, we have got 200%. That means your debts, they are more your equity by 2 times if it's 200, right? That means your debt more than 200 than your equities. Any questions so far? No. If no, we can move on the next one. It's equity multiplier. How to calculate is equity multiplier is equal to 3. After calculation, we have okay. Let's see the formula. We should take the total assets divided on the total owner's equity, right? Where total assets is equal to 3,300 and owner's equity 1,100. That means all your total assets is 3 times more than your owner's equity. Okay, your assets more than owner's equity by 3 times, by triple. Let's see triple. So let's see the next one. Next, we have a ratio profit margin. After calculation, we have got the 40.42%, right? The profit margin, you remember, we have this formula in previous exercises. We should get the net income or net profit divided on the sales, right? This simple one, right? Some of you can see the formulas are very simple. Just taking your mind, taking your mind. The return on, I think we didn't have this formula in the presentations. Let's see, after calculation is equal to around 70%. So based on the formula, we take the net income divided on total assets. And we've got the 70%. So our return from our assets that we are using is equal to 70%. That means for every $1 of your income, of your assets, $1 of your assets, you're generating 70 cents of the net income. Okay. Let's see the next slide. Yes, here is also you should multiply if it's given in the percentage. You should multiply on the 100. Just it's hidden only here. You don't mind, but you just should remember that. Anyway, if the rate in the percentage, just multiply on the 100. That's all. So next one is return on equity is equal to 209.45%. Say the return on equity we sometimes call ROE. The formula is net income divided on the total owner's equity and multiple on 100. And you can get in the percentage. Okay. That means what this formula means. That means you using your equity. You're using your equity for 2 times then to get your income, like for 2 times like a better. That is, here is the more than the percentage, the more the bigger rate is good for the company. That means a business getting around 210 return using the equity. That equity is being efficiently used, very efficiently. Okay. Okay. The next one, payout ratio. What is the payout ratio? Here is after calculation given to you, answer is equal to 28.26%. So in the explanation given to your formula, you should get your dividends paid, that you pay dividends, and divide on the net income. Okay? That means 28%, around 28%, you get the dividends from your income. From your income. But your income includes the 28 only for dividend, which is dividends paid for. Okay, next one is the rotation ratio. The rotation ratio is equal to 74%, around 72%. The formula given to you, you should addition on the retained earnings, divide on the net income. And here is the note given to the sum of the payout ratio and the rotation ratio is 100. You must remember it should be equal to 100%. Let's back and see in the income statement these figures. Here is net income given to you, 2,304, right? Let's see yes, right. The net income 3,004, and the addition to retained earnings given to you also is 1,653. And times on 100 to get in the percentage ratio. Let's see the next one. We have some price earnings ratio, PE ratio. Sometimes we call it PE ratio. After calculation, we have got the 2.35 explanation. So we should take the price per share and divide on the earnings per share. You remember in the income statement we have some additional information. We have a price per share is given to you 10.83, and the earnings per share is calculation for the earnings per share is 4.61. So to get them the earnings per share, the 4.61, you should do this calculation yourself. That means you should take the price per share. Here is given to, okay, let's see. We take the earnings. We should take our earnings and divide on the price per share. Okay. And let's see the next slide. So we have some market to book ratio. Market to book ratio is equal to 4.92. The explanation, we should take the price per share, divide on the book value per share. So here is given to the price per share, you remember, is 10.83, and the book value per share is $2.2. So note, see the EPS book value per share calculated for additional information. So how to calculate the book value per share is 2.2. For this formula, give you later. Because it's been hidden here. So give you in the next session how to calculate the book value per share. Okay. So earnings per share given to you. How to calculate the earnings per share? We should get the net income and divide on the number of shares outstanding. And we have got the earnings. We have some earnings. We have some profit from the per share is around $5. You remember, you should get your net income, which is equal to 2,304, and divide on the number of shares outstanding, 500. Let's back on the income statement. You have here is the other information. You have a number of shares outstanding is 500. So calculation given to you already. So how to book value per share? How to calculate the book value per share? Is it equal to 2.2? You remember we had in the previous slide, here is book value per share, here is. So calculation for the book value per share given to you later, right here. We should get the total owner's equity, divide on the number of shares outstanding. Total owner's equity, which is equal to 1,100, we divide on the number of shares outstanding, which is equal to 500. And we got the book value per share, which is equal to $2.2, right? Okay, this formula, you don't have these formulas. The last three formulas, you don't have. Okay, the price earnings ratio, you don't have the formulas. The market to book ratio, how to calculate the earnings per share, and how to calculate the book value per share. These formulas, you must remember, you must save in your notes. And so far, that's all. So we have calculated all the ratio based on these exercises. So here, let's see, we had 1, 2, 3, we have 23 kinds of ratios. and you have 23 formulas for those ratios. So you should you should copy all these formulas and prepare on your exams, because that will be help you to easily make a calculation. Okay. Of course, I know that you can't remember all those formulas in your exam. It's difficult to remind all of them. Around 30 formulas for ratios. But you just can print these formulas to prepare the list of the formulas before your exam would be started, and that will help you to make easily and faster calculations. Okay. So any any questions so far for the exercises, for this exercise number 6? Any questions for formulas or the assignments itself? If you have some questions, if you are feeling that you're confusing and it's too difficult, maybe you didn't understand some of the calculations, just let me know. Maybe we can do some another practical exercises. If no, we will move to another chapters. We will move to another analysis, to another calculations. So far for this moment, you can prepare the balance sheet first, right? You can prepare the income statement, and you know what is the cash flow statements. And based on these 3 statements, we always do some practical exercises. First, we have done some ratio analysis. Next one, we would have another kind of analysis. For the next session, I would just want to share with you, just show you what kind of exercise chapter we have. Just a moment. Because all these kind of exercise will be on your exams. So next chapter will be based on the capital expenditure decisions, which means the capital investment decisions. How to make the decisions on your investments. How to make decisions. And here is in this chapter we have also some the methods which we can use to make any investment decisions. And for these methods, we have also some calculations based on the formulas. And it's also very important. Just try to read this presentation before the next session will be started. Try to read books also that I given to you, the e-books, you remember, the Weaver and Weston authors. And based on that e-book, you have this chapter on the chapter 9. Just will type for you which chapter, which book. Do you remember the book that I sent you? The Weaver and the Weston authors. Weston. And the chapter is 9. You can open the chapter 9, and the page starts. Just a moment. It's called the chapter 9 Capital Investment Decisions, page 211. So read it. Yes, I know some of you said that we didn't have some exercise based on the cash flow. Okay, based on the cash flow, we will have some exercises later with the chapter number 6. But you didn't have the exercises how to prepare the cash flow itself. Don't worry, I check some class based on this issue, and we try to prepare the cash flow itself. And another question, some of you asking when the exam will be. So let's say today we have the session number 8, and we have another 2 sessions, right? The sessions number 9 and 10. And I think we will check another additional 2 classes to make practical exercises. And exam will be after those practical exercises. Maybe perhaps it will be in the September. In September, the beginning of the September, the exam will be in the beginning of the September. Before the exam, we will check some 2-3 classes for exercises. And exam, you should know that the exam will be online. That means you should prepare all your formulas, calculator, and so on. Should be prepared for the exams. The exams will be during the 2 hours. At the starting, I give you the assignments on the exams. The assignments will be based on the ratio analysis, based on the investment decisions, based on the income statement, balance sheet, based on the statement that we've been prepared. And some theoretical questions also will be there. And the first 5-10 minutes give you to read the questions and to ask me if you have some questions related to assignments. And then you do your calculations. You do your calculations, and you write your answers during the 2 hours. And at the end of the session, you should send me the answers for the exams to my email. I've give you some specific time, like limit time until which time you should send me your answers. Who would send later, I won't be taking it in the account. You should remember. Okay, so the most important things, prepare all your calculator on the table, prepare all the list with the formulas that we have done, and review the theoretical chapters also. Okay. And before the exams, I give you maybe around 2 weeks to prepare to the exams, okay? And for the exam questions, before the exams itself, I give you some practical exercises which is similar to exam exercises, okay? You remember. We will do some practical exercises which is similar would be to exam exercises. That means you might be able to give me the right answers for the exams. The exams will be in September, okay? I can't say you which date because we should take some additional classes, 2 or 3, and I give you another 2 weeks to prepare, and after that will be exam. Will be around in September, I think so. So that's all for today's session. After class, we'll send you the presentations. Please review the books that I sent you, the Weaver and Weston, the Finance for Non-Financial Managers. You review the chapter number 7 for ratios and chapter number 9 for investment decisions, because the next session will be also difficult to understand. I mean, it's a huge session and huge chapter, and takes a lot of time and your effort to understand the topic itself. Okay. So that's all. Thanks a lot. And so goodbye. I won't give you some practice exercises, because you just you should just review your the previous exercises for based on the ratio analysis. Just review what I give today for you. The exercise number 6. Just review all the formulas and the calculations. So thanks a lot, and good luck for you, and see you on the next session.